Hey, welcome back everybody. You're tuning in to howtoplaystock.com. My name is Casey. Today is January 22nd, 2018, and I hope you guys had a good weekend. I know a lot happened over the weekend. We had a government shutdown, and the government right now is still trying to continually work out their problems, but they fight amongst each other and they can't get anything solved. So, um, I honestly I wouldn't worry about that too much. Just focus on your investments, focus on what you've been doing, and if you follow my channel, you know what to do. Okay, so with that being said, go ahead. If you haven't subscribed to the channel, go ahead and subscribe to the channel. Go back and watch a few of the videos that I have on investing for the long term and getting a well-balanced portfolio together. Because today's video, I'm going to touch a little bit more on that topic. Okay. Now, I've been reading a lot of books lately, and I just finished one here. It's called The Sell of a Lifetime. All right, now I've got some videos that I shot previously on some of the charts I was looking at and studying from that book. But today's video, like I said, is focused on having a well-balanced portfolio, and we're going to talk about bonds for a minute because there's some great opportunities coming up in the bond markets, especially with a recession or a depression that I think we're heading into over the next 5 years. Okay, now nobody really knows for sure when that's going to happen. Nobody can call the top, nobody can call the bottom, and if you have anybody that tells you they know for sure, don't believe a word they say. Quite honestly, they're full of crap if that's the case. But getting back to the book and the information that I'm getting out of this, I wanted to just cover one thing here because he talks about in this book some of the opportunities of a lifetime that are going to come your way, especially if you're a millennial and you still got some time on your hands here, okay? Now, and it's interesting because, he covers not necessarily having a well-balanced portfolio, but he covers some of the different asset classes within a well-balanced portfolio that are going to perform very well. And he's taken data out of historical charts, dating back to the beginning of the U.S. economy. And one of them here, I'll just read it real quick. One of them that he says you really need to pay attention to would be high-quality long-term government bonds or treasuries and AAA corporate bonds. Okay, that's coming from page 298 from The Sell of a Lifetime. And the reason why he talks about that is because in a recession, and we'll go look at a chart here in a little bit on the Dow Jones, but in a recession or when bubbles pop, you always get you get a peak up here, but they always revert back to a means, which means that they'll come down to where they first started, or they'll drop a little bit below that. Okay, so and then I'll show you in a chart here in a minute what I'm talking about. But moving forward, I've got a couple video clips that I put together for you as well that we're going to watch. One of those is from Kevin O'Leary, and he's from Shark Tank. He's the creator of O-Shares Investment Funds. Jim Cocken, he's Chief Fixed Income Strategist for Wells Fargo Management. Okay, now I don't know this guy very well. I haven't really paid attention to him too much, but he did say some interesting things about bonds and why you would want to get involved with those. So we're gonna look at a clip from Jim, and we're also going to look at Ray Dalio, who's the founder of Bridgewater Associates. He owns the world's largest hedge fund of about $160 billion. So when these guys, speak and talk, I like to pay attention to what they have to say. Okay, and then what I do is I go out and I'll look for information in books or articles, stuff that's out there on the internet, and I'll try to bring everything together and put the puzzle together for you so you can better understand what these guys are talking about, okay? And that's what I'm going to do with this well-balanced portfolio because, again, if you haven't subscribed to my channel, go back and subscribe to the channel. You can watch some of my videos on getting a asset allocation together for your portfolio that's going to basically endure any type of storm that comes your way. And that's very important if you're investing for the long term because a lot of people want to buy and hold. Okay, and buying and holding is not a bad thing to do, especially if you're looking for the long term. And the reason why is because a lot of people can't time the markets, and a lot of people don't have the time to go in and look at charts on a daily basis and try to day trade their way to wealth. it just doesn't work, because 96 to 97% of professional hedge funds can't even match the returns of the S&P 500 on an annual basis through the long term, and that's only at about 9% return. So it's very imperative that if you're going to invest for the long term, build some wealth, you're going to want to have a well-balanced portfolio. And I'm going to show you some of these clips here in a minute on what some of these guys have to say about having a well-balanced portfolio, and specifically with U.S. bonds being a part of your asset allocation, okay? So keep watching, and I'll take you in on the charts here. All right, so what we're looking at here is the Dow Jones. This is a current chart, and it dates back to 2009, and I'm looking at a weekly chart. Okay, so you can go out on the internet, pull up any chart, and look at the Dow Jones right now, and you're going to see something exactly like this. Now, I drew a red line going upwards, as you can see here in this video, and the red line represents the support on the weekly chart. What's funny about this chart is if you look at that weekly support, okay, we haven't dipped below that support line since 2009, which tells me that if you're looking at this chart, what's it remind you of? I mean, what asset class out there looks a lot like this one right now? I'll give you the answer. It's Bitcoin, okay? And you can see what happened to Bitcoin just in the last 3 or 4 weeks. What did it do? It came down in price by about 50%. All right. So if you think the Dow Jones is going to continue going upwards to infinity, you're mistakenly wrong. All right. Now it could go to 28,000 or 30,000 points. All right. But it's going to have to revert back down to a means of where it started. And like I said at the beginning of this video, if you look back at historical charts and you take a look at some of those, specifically charts that are in the book The Sale of a Lifetime by Harry Dent, you'll see, and these charts go back to the 16th century. When it comes to bubbles, every single one of them has reverted back to where they started. And if you look at where we started back in 2009, we were down here on the Dow Jones at about 7,500, close to 7,000 points. So in order for all the deleveraging to take place and for deflation to work its way through the markets so that we can get fair valued prices again in the markets, and then reset into a new 80-year 4 seasons cycle, which would last about 80 years, it's going to have to revert back to the means where it started. So that's an excessive amount of deleveraging that will have to take place. And again, like I've said, it's nothing to panic about. It's more or less you need to be prepared, and so you can take advantage of this, okay? So now we'll go to another chart, or I'm sorry, not another chart, but we'll go to a little piece in the book Rich Dad's Prophecy by Robert Kiyosaki. There's a little section here where I highlighted what Warren Buffett had to say about diversification, okay? He said diversification is it's protection against ignorance. It makes very little sense for those who know what they're doing. So I'll repeat that. It makes very little sense for those who know what they're doing to diversify. And the reason why he says that is because, Warren Buffett knows what he's doing. So he can go in on just one asset or two assets, and actively invest in it and watch it over time because he has the time to do so. So for him, it doesn't make sense. But he also says, that he's not saying to not diversify. He has repeatedly said that he does not diversify, but he is not advising you or anyone else to not diversify. He is simply saying that diversification is protection against ignorance. And in other words, if you don't want to diversify, what he's saying is get educated. If you're not financially educated and have no plans on becoming financially educated, then you diversify. And so that's what Warren Buffett had to say about diversification. Now, this next portion of the video, again, we're going to watch some clips here of what others have to say about having a well-balanced portfolio. You're going to hear from Kevin O'Leary first, Jim Cocken second, and then Ray Dalio.
I learned years ago, and this is just a fascinating, one of the things in life that it just comes from a unique experience. My mother used to take a third of her paycheck and put it into large cap dividend paying stocks and corporate credit back in the early 60s. And when she died, this portfolio had existed for 50 years. And as an executive, the first time I got to look at it, she'd hidden it from both of her husbands. It was amazing. If dividend paying stocks and corporate credits over 50 years, you can't find an index that beats that. And so when I started to do some research, I found out one interesting fact that changed my investment philosophy forever. Over the last 40 years, over the last 40 years, 71% of the market's returns came from dividends, not capital appreciation. So rule one for me is I'll never own a stock that doesn't pay a dividend, ever. Number two, diversification really matters. So I never want to own more than 5% in any one name, and you know that really works when you go through periods like 08, 09, we have volatility in sectors. And number three, when you start to look at capital for multi-generations, you want preservation.
So if you're not going to make any money on treasuries, where can you make money in the fixed income world?
Well, making money these days means collecting your coupon. You're not going to get capital gains out of bonds this year. You might get capital losses out of treasuries. But those areas where the coupon income is still fine, is still relatively generous, would be high yield corporates and some areas of the municipal bond market, the single A, triple B credits in the municipal market.
And how do you choose the right municipal bond or bond fund portfolio? Because we keep reading every day in the news about another state or city having problems, especially with its pensions.
I would let the professionals pick the bonds to own. In other words, use a professional manager, use mutual fund managers, because they have credit research capabilities. And in this market, where the values are in single A and triple B credits, not in triple A credits, credit research is extremely valuable. It's extremely important. And that's what you get with professional management.
What about the whole idea of emerging market bonds? It's understandable that people want to stay away from Europe and you're not getting any yield here in the US. But what about in Brazil or China or Malaysia, Indonesia, one of these far off lands?
It's the emerging markets have outperformed domestic high yield moderately by about 2 percentage points a year these last 2 years. So there's some additional income there. I'm not sure you're getting paid for the additional risk in the emerging debt markets. I would stay, if I wanted to take credit risk in the taxable arena, I would concentrate on domestic high yield. I think you're capturing almost as much income with less risk.
Investing just for a moment. We're 8.5 years into this bull market. You've given us an idea where we think we are in it. You've told us what some of the challenges are. When there is a correction, there's a correction every year. People don't realize on average since 1900 we have a correction. I remember last year in January was the worst January in history. Everybody's freaking out. They all came to you at CNBC and said, "You're in Davos, and what do we do?" And you talked to them about what they can. Calm down, don't overreact. Tell me how you came out. I don't want to go through it now because at the times it's in my book so people can read the chapters. But this whole idea of finding out how you can not know where the markets are going to go and yet still win. This idea of the all-weather that you came up with, and you adapted it for me to share. You're unbelievably generous with my readers and with anybody who picked it up. We call it the all seasons. It's not quite the same. But it's been right 85% of the time you would have made money in the last 75 years. And when you lose, the most it's ever lost is 4% on that formula. How did you come up with it? What made you pursue that? And what would you say to people that are panicking when the market's going to crash any moment and they've been sitting on the sidelines missing one of the greatest bull markets in history?
I'm going to give the brief answer, and then which is that diversification properly balancing means that you could take equally good things and you can reduce the risk. And because
I just want to clarify. You said that the holy grail of investing you found early on, changed your career, and it was how you could reduce your risk but not reduce your returns. How did you do that?
By knowing how to balance, okay? When you can take equally good things,
yes,
they're equally good, so your expectation of return is equal,
yes,
right? But because they're uncorrelated,
yes,
because they move differently, They balance each other.
So one goes down, the other one bounces
Right.
up. Right.
And I would love to get into it, but you know, I'll just repeat, what you did is provide a great service. It's in your book.
Yes.
So anybody who reads that book has taken the time, and you've put it in a language that everybody can understand in a way that we won't have the time to go through now. So it was great for me and great for you and great for those people
Yes.
that we could communicate how they could achieve that balance. It's so important because you have to understand that in order to beat somebody, the market's a zero sum.
Yeah.
And
Somebody
adding
wins, somebody
value,
loses.
that's right.
Yeah.
And so the consensus is reflected in the price.
Yeah.
And so you have to be better than that. I put hundreds of millions of dollars each year in trying to play that game well,
Yeah.
and others do. And it's a difficult game. It's more difficult to compete in the markets and be successful than to compete in the Olympics.
Yeah.
So be humble about that. It's difficult.
Yes.
But to achieve that balance so that you understand how you can get that good return without losing a lot of money
Yeah.
is something. You've communicated it well, so I would, rather than be
Yes,
able to
well,
cover
your
it,
book, yeah.
recommend that they look at your book. That
But your
you
money is,
communicate.
all your personal
Most
money
of my money is in that.
is in that. It's
That's right.
truly amazing. And people, you can go pick up a book or go to the library, whatever, and get the answer because you walked us through it. We did it in 2 chapters of the book, and it's mind-boggling. I mean, if you could go to Vegas and be right 85% of the time and make close to 10% on average, and when you're wrong, the most you ever lost is 4%, how often would you invest, right?
Well,
It's a different
yeah.
game, right?
Yeah, the risk of ruin
Yes.
is so diminished.
Yes.
You know, it depends exactly how you construct that in
Yes.
terms of what your risk and return is. So it's explained there. But the risk of ruin, like, you know, any one investment, there will come a time in your lifetime that it's going to be down 50 to 75%.
Yeah.
And when it's down 50 or 75%, if it's down 50%, that means you have to make 100% in order to
Yeah,
get
to get
back.
even, yeah.
So you can't afford those kinds
Especially if
of
it's later
things.
in life, you don't
Right.
have the time, right?
Right.
Yeah, yeah. So this is really the way to protect themselves. So many people get great returns, but then they also slash to the bottom. And
But
one of
this
your
is-
principles
these
is
are-
not lose
these-
money. It's
these are
stay
good
more above it.
returns, yeah.
These are great returns, but you're limiting the downside massively.
Okay, so I hope you guys found that interesting, and paid attention and maybe took some notes on some of the clips of what these guys had to say in regards to a well-balanced portfolio and, what their opinions were on some of these treasuries and bonds, okay? That's all I have for today. You're tuning in to howtoplaystock.com. If you haven't subscribed to the channel, please do so. Hit the like button if you like this. It helps my videos move up in rankings so that we can share this with other people, and it helps support the channel. So I would greatly appreciate that. And with that said, guys, remember, income is the outcome, okay? I'll talk to you later.